Welcome to the economics class part 4. So in this class we shall be covering what are the reserve ratios and its types, then what is liquidity adjustment facility, and how does the RBI influence money control in the economy, and also at last we shall be seeing what is the poverty, its type, the types of poverty, and the committee related to poverty. So beginning with, we have reserve ratio. So what do you understand by the term reserve ratio? So as it is mentioned, the reserve means savings. So it is nothing but the types or how the RBI or the bank saves money. So we have two types: cash reserve ratio, statutory liquidity ratio. Now, what is cash reserve ratio? So it is a percentage of bank's total deposits that must be kept as a cash with RBI. So in cash reserve ratio, the bank has to preserve or save some part of the money with RBI. So the current ratio is 4.5%. So for example, if I tell you, uh, imagine we as a citizen go to the bank and deposit money. So the bank has money now. So what does bank do? So under cash reserve ratio, bank has to keep the money they got from the citizens with RBI. So they have to keep 4% of the money what they get from the citizens with RBI. So if bank gets 100 rupees, 4% of 100 rupees is rupees 4. So rupees 4 they have to preserve with RBI. So they have to reserve the amount with RBI. So remaining 96 rupees they can use for other purpose such as giving lending loans to people, then spending on infrastructure. So here what happens when CRR increases? So when cash reserve ratio increases, inflation decreases. How? When the interest rate increases, bank has to reserve more money in RBI, right? With RBI. So there is less money with banks. So they will provide less loans to people. So vice versa of it is when CRR decreases, inflation increases. So bank has more money with them. So they have to keep less money with RBI, right? So what happens in statutory liquidity ratio? Here they need not reserve money with RBI. So that is the difference between CRR and statutory liquidity ratio. Here they themselves have to reserve some amount. So the amount is 18%. So same case here as well. When SLR increases, inflation decreases, vice versa of it. So moving on, we have liquidity adjustment facility. So what do you mean by this? So there are two types: liquidity adjustment facility and marginal standing facility. So in liquidity adjustment facility, so this is a tool used by RBI to manage short-term liquidity in the banking system. So this is done by the RBI. If the RBI wants to increase the money supply in the society, it will either give money to the bank or borrow money from the bank. So this is done through repo rate and reverse repo rate. So if you still confused with the terms, so watch the previous video of economics part 3. There I have clearly mentioned with an example what is the repo rate and reverse repo rate. So once again I will tell you repo rate in the sense the bank has to, here the RBI lends money to the bank. So bank has to pay interest to the RBI. Whereas in reverse repo rate, bank lends money to the RBI where RBI pays interest to the bank. So that is the difference. Now what is marginal standing facility? So here banks can borrow money overnight. So if a bank instantly wants money, they can borrow money from RBI through marginal standing facility. So this is in case of emergency. But here the condition is the interest rate will be higher when compared to repo rate. So if I tell you if repo rate is 6.5% and bank wants money emergency, so it is an emergency. Bank wants money. It can buy money from RBI through marginal standing facility (MSF), but the interest they have to pay is more. So if the repo rate, if the original repo rate is 6.5%, and if they want money through MSF, they have to pay extra 0.25% of interest. So the total interest will be 6.75%. So that is the difference between MSF and the LAF, right? So moving on, we have another concept that is collateralized borrowing and lending obligations, CBLO. So what is this? So CBLO is a money market instrument used in India for short-term borrowing and lending backed by collateral. So collateral, as I told you in previous class, it is nothing but a guarantee for safer side. So this was introduced by the Clearing Corporation of India Limited (CCIL). So let me give an example. So let us understand through an example. So what is a CBLO? So imagine there is a bank A and bank B. So if a bank A needs 100 crore rupees for one day and bank B, so if you imagine bank A here and opposite of it there is bank B. So bank A wants money, that is bank A wants 100 crore rupees for one day and bank B has surplus money, so they are ready to give money to bank A. So they gave 100 crore rupees to bank A. But what is the condition? The condition is that before receiving 100 crore rupees from bank B, they have to give collateral of 1 105 crore to bank B. So what happens? So bank B gave 100 crore rupees and bank A gave 105 crore rupees as a collateral to bank B. So after one day, bank returned the 100 crore rupees taken from bank B, and bank B also will return the collateral given by bank A to bank A, right? So that is done under CBLO, collateralized borrowing and lending obligations, and it is introduced by the Clearing Corporation of India Limited. So moving on, we have three types of market: bond market, forex market, stock market. So stock market, as we all know, it is nothing but the buying or selling the share of a company. So we all do on the daily basis. So still, if you want the example, I'll tell you, if you buy a share of a MVP company for 1,500 rupees, and as days pass on, the price increases and it reached to 1,800. So the price of share one from 1,500 to it reached to 1,800. So there is 300 profit for you. So you invest in companies. So that is done under stock market. So in forex market is nothing but where we exchange the currency of other country to other country. So if I move from India to America, there rupees doesn't work. So I have to exchange the rupees to dollars. So that is done under forex market. So what is bond market? Here people give loan to government or companies. So here people invest their money and in turn the government will provide you interest. For example, if you buy 1,000 rupees government bond with a 7% interest, the because of the interest the government will pay you 70 rupees every year. So this is for long term. So here it is nothing but you are investing to the government and the government is paying you the interest. So every year they pay you 70 rupees if the 7% is the interest. So when you pay 1,000 rupees, so when you buy the government bond for 1,000 rupees, and imagine if the government pays you 7% interest. So every year you get 70 rupees. So this is for long term. So it's a long term goal. So these are the three types of market. Now, what is a lender of resort? So we call RBI as a lender of resort. Why? Because the RBI gives emergency loans to the banks. So, for example, if a commercial bank, so if any commercial bank is running out of money, so they drained out all the money. So they want money. So because there is an emergency, they want money. So that time RBI lends money for emergency purpose. So we call RBI as lender of last resort. So if I give an example, if this is bank A and bank B, and bank A has drained out all its money, and bank B is not ready to provide money, so that time RBI enters. So RBI is ready to give money to bank A. So we call RBI as lender of last resort. But the exception is here, bank RBI doesn't support trade industries, and also the one misconception is that here, if the government wants the money for emergency purpose, RBI doesn't give money to the government through lender of last resort, but it is termed as banker to the government. So that is the exception, we have to make a note of it. Now, there are two types of interest rate, nominal and real interest rate. So what is nominal interest rate? So interest rate shown by the banks on savings or loans where it does not consider inflation, rise in price, right? For example, you deposit 10,000 in bank. So you deposited 10,000 in bank and the interest rate is 8%. So under nominal interest, here what happens? The exception is the difference between the nominal and real interest rate is here they provide the final amount without deducting the inflation. If I say if you deposit 10,000 in a bank and bank gives provides you 8% interest, so after a year the amount will be 10,800, right? So in the course of 1 year there was inflation as well, so there was 5% inflation as well. So even though your money reached from 10,000 to 10,800 and there was inflation between that course of 1 year, so you lost 500 rupees, right? So you only gained 300. So under nominal interest rate they won't tell you the inflation factor here, right? Whereas in the real interest rate they publish the final amount deducting the inflation. So this from this we can understand the actual gain or the loss occurred during the course of time. So the formula is the real interest rate is equal to nominal interest rate minus inflation. So here they will consider inflation and deduct the inflation with the real amount and then publish the final amount. Now, now what is poverty? What is the definition of poverty? So according to UNHR, United Nations Human Rights Council, so when human condition is characterized by sustained or chronic deprivation of the resource, capabilities, choices, security, and power necessary for the enjoyment of adequate standard of living. So when a human lack all these qualities or the conditions, that type the human is called as is in poverty. So we have the international poverty line published by the World Bank. So what did they say? A person living below $2.15 per day is termed as poor. So this is based on food, clothing, and shelter, and it does not include sanitation, water, electricity. So this is the point we have to remember. The condition published by the World Bank, that is a person living below $2.15 per day is considered as poor, right? Based on what? Based on food, clothing, and shelter, but not sanitation, water, electricity. So there is another term called as a head count ratio. So HCR, what is head count ratio? So this is nothing but the percentage of people living below poverty line in a country or a region. So this is calculated by number of people below poverty line divided by population into 100. So they might ask you the formula. So it's not so important. Moving on, we have other concept called as multi-dimensional poverty line. So this is important. So this was launched in 2010 by UNDP plus UNDP along with Oxford Poverty Human Development Initiative. So this is a collaboration by the UNDP plus Oxford Poverty Human Development Initiative was launched in 2010. So they published 10 indicators. So they published three dimensions, and under three dimensions there are 10 indicators. So what are the three dimensions? Health, education, and standard of living. So under health they consider nutrition, child mortality. Under education, years of schooling, attendance of school, and under standard of living all these qualities should be fulfilled, that is cooking fuel, sanitation, drinking water, electricity, housing, assets. So the under the multidimensional index all these criteria, if a person deprived of these conditions, that is one third or more, so if he's deprived of these conditions, if he does not so he's not able to access through the nutrition or the uh, basic necessity, that is cooking fuel, then sanitation, drinking water. So if he lacks these criteria, then he is considered as poor under multidimensional poverty index. Now, what are the types of poverty? So we have two types, the absolute and relative. So absolute poverty is nothing but when people don't have enough income to meet basic needs of life, such as food, shelter, clothing. So he's lacking basic needs. So that is called as absolute poverty. So as I told you, under the international poverty line by the World Bank, when a person is earning below 2.15 per dollar, so he's considered as poor. So that comes under absolute poverty, where is lacking basic needs. Whereas in relative poverty, here person is able to fulfill all the basic needs, but when compared to other people, he is poor. For example, if a person A is able to fulfill all the basic needs, that is access to water, sanitation, food, fuel, whereas person B, he has access to basic needs as well, plus all the other luxury life. He owns a car, a property. So compared to A and B, A is inferior to B, right? So that is called as relative poverty. So how do we measure absolute poverty in India? So this is carried out by Niti Aayog's task force. So the absolute poverty is calculated in India by the Niti Aayog's task force. So they consider consumption and expenditure but not income level. So this is measured by Niti Aayog's task force looking to consumption and expenditure but not income level. So this is mentioned under the poverty line basket, where this basket includes whether he is able to access or get food, clothing, housing, health, education, or transport. So there were some committees uh, in India to measure the poverty. So the three committees are the Laktawala Committee, Tendulkar Committee, Rangarajan Committee. So these three committees are important, and rest of the committees can go through, but not so important. So the first committee was the Laktawala Committee, so established by the Planning Commission of India, headed by Professor D.T. Laktawala. So purpose of this committee was to revise the method of estimating poverty in India. So here they considered that if a person is able to consume 2400 calories for rural areas and 2100 calories for urban areas, so he is considered as not a poor. If he is not able to consume so much calories mentioned here, he is poor. But the drawback was they did not account for health and education. They only focused on calories. So to revise this, the next committee that came was Tendulkar Committee. So they shifted from calorie intake to consumption expenditure. So they moved these calories norms, what they mentioned in Laktawala Committee. So Tendulkar Committee calculated poverty line based on actual spending on food, health, education, and shelter. So he declared that daily per capita expenditure of rupees 27 and 30 should be minimum, or else he is poor. Then third is the Rangarajan Committee by the Dr. C. Rangarajan, former governor of the RBI chairman of Prime Minister's Economic Advisory Council. So he considered based on the actual minimum consumption needs, not just food. This included food, education, health, clothing, house rent, transportation, and electricity, and also revised the calories intake, that is 2155 calories day for rural and 2090 calories for urban. So that's all. So I shall be uploading the next concepts of economics in part 5. Till then, stay tuned. Thank you guys.